Good morning, good afternoon, good evening, everyone, and welcome to today's discussion on Asian trade finance and supply chain as part of the Corporate Finance Forum series hosted by Coalition Greenwich, division of CRISIL. My name is Gaurav Arora, and I lead Coalition Greenwich's practice across Asia and Middle East. Before I introduce my esteemed panelists and get started, let me cover a few housekeeping items. When you entered the webinar, the system automatically put you on mute and turned off your webcam. You are in a view only, listen only mode. If you have any questions, please feel free to use the Q&A button at the bottom of your screen. You can submit those questions at any time. If you are facing any technical issues, you can use the Q&A option as well, and we will try our best to assist you. If you're joined on the computer and prefer to use the telephone audio, click on the arrow next to the microphone and then click to switch to phone audio. Finally, this webinar is being recorded and a link to the recording will be sent to all attendees along with the copy of the slide deck. With that, let me introduce today's panel members. Today we have Sophia Hamucha, BNP Paribas' Head of Transaction Banking for Southeast Asia. Based in Singapore, she leads a team of cash and trade and supply chain finance specialists who develop, implement, and service trade and treasury solutions for corporate clients across the region. Sophia started her career with BNP Paribas as a graduate trainee in 2000. And since covered several roles in credit risk management, internal audit, business development, and strategy in Paris and Singapore. Kanika Thakur, Citibank's APAC trade head based in Hong Kong. Kanika is responsible for the continued growth of Citi's trade business, as well as the business's digitization priorities and progress. Kanika joined Citi in 2001 as a management associate in India, and has since worked in Singapore and Hong Kong, holding a number of different roles within transaction banking, including sales and structuring, product management, and distribution. And finally, Macy Chong, Standard Chartered's Head of Trade for ASEAN and Singapore. Macy joined Standard Chartered in August 2020. In her current role, Macy is responsible for leading the continued innovation and development of trade finance product capabilities across the region. She's a big proponent of leading digital and sustainable trade finance initiatives in ASEAN. Macy is a seasoned transaction banker with extensive experience in sales, structuring, and product management in the supply chain finance space. Let me also take the opportunity to introduce Coalition Greenwich, leading provider of market information, insights, and client intelligence to the financial services industry. Coalition Greenwich is a part of CRISIL, S&P global company, following the integration of Coalition Development and Greenwich Associates in 2020. We wanted to kick this discussion off by sharing some insights from our recently concluded Asian large corporate trade finance study. These insights are based on detailed interviews with large Asian corporates and Western multinational subsidiaries with at least $500 million in turnover. So let's go through some of the key trends as we see them. If you look at the impact of COVID-19 on global trade flows, it's not a surprise that back in Q1, Q2 of 2020, overall trade volumes were down significantly. However, it is also quite evident that the market has recovered quite rapidly. Since then, with trade flows increasing dramatically led by Asia. There are still concerns highlighted by leading corporates in Asia around the increasing supply shortages, leading to spike in raw material prices and freight pricing being at the highest levels that we have seen in a while. Apart from these business concerns, there are other risks around resurgence of COVID in different markets, as well as geopolitical challenges with US, China, and others. This certainly has had an impact on how corporates think about their trade finance providers. While we continue to see competitive pricing as the #1 factor, we do have to recognize that it has reduced in importance over the last couple of years. Whereas quality of e-banking and digital platform for trade finance has grown 3x, clearly highlighting the rising importance of digitization or digitalization in trade finance. We can also see on the right-hand side that the share of execution through the digital platform is now ahead of other traditional channels like emails, courier. We all know trade finance is a very manual, paper-based business, and we are seeing a rapid evolution of that business. We're going to get into some of those details during the panel discussion. We also see a gradual increase in usage of third-party solutions, whether those are fintechs, techfins, or other third-party providers. As you can see, the proliferation, albeit a little bit slow, is still increasing in Asia. Looking through some of the reasons for corporates not yet using some of these third-party platforms or solutions, we do expect that this trend will accelerate as more and more platforms in the region become more complementary and become integral to an ecosystem play, which is quite essential in this business. One of the other big trends, which is not just in this business, but across the globe, which we are seeing is around ESG or sustainability. While speaking to finance department heads in large corporates across Asia, as you can clearly see, more than half of them have clearly defined ESG goals. And while the remaining said no, it is more reflective of the department rather than the organization as a whole. We all know that ESG is universally important to everyone right now. Companies already do rely on their banking providers for things like green financing and funding, etc. But there are still a large number of corporates who do not yet know how banks can play a role in helping the organization or the department meet their ESG objectives. Clearly, there is a gap in the market, and we will discuss this topic at length with our panelists. And as we think about the broader long-term challenges and the changes for this business, there are many different factors which are impacting this business, ranging from geopolitical aspects like US-China, emerging technologies, platforms, ecosystems, and the rise of ESG. For today's discussion, we will focus on three key themes, starting with more of a macro view on supply chain resilience amidst a changing environment, accelerated digitization or digitalization, and sustainability. On that note, I want to now pause and open the discussion to my fellow panelists. In order to keep this discussion quite focused, we will be using this framework to get into details for each one of the stages. So let's start with the macro picture. And since the large part of the recovery or trade flows was driven by Greater China, let me start with Kanika. Kanika, as you see this strong rebound on trade flows, what is the key impact which you are seeing on the ground, especially with the challenges which come along with the recovery? So things around the commodity supercycle, freight pricing, raw material pricing changes. How do you see this recovery panning out, and how sustainable do you see this recovery to be?
First of all, Gaurav, a pleasure to be here, and thank you for having me. I think, if we maybe go back a little bit in time to go through how the crisis began and how the impact began on some of the North Asian markets and then shifted wider to what we're seeing today in terms of trend of recovery. And you alluded to a lot of the key areas that are becoming areas of focus for corporates and as a result for banks as well. So, sometime late 2019, early 2020 is when the impact began in large measure in the North Asian markets and then spread wider to Asian markets and beyond and going westward thereafter. At the beginning, what we saw was corporates, of course, looking at how do they come out with business continuity plans and how do they sort of sustain business through an environment that was completely unknown and uncharted. Will I be able to ship? Will I be able to manufacture? Will my raw materials reach me, etc.? And I'm sure all of the viewers of this panel would hopefully be nodding their heads like you are on the similarity of the challenges that were faced around that time. Now that opened up a huge number of thoughts for the medium term for our based on what we've heard from our corporates as well. One was, as your survey also rightly shows, not just for banks, is price the only determinant of manufacturing of goods and services and banking services? So, is my cheapest cost location the only factor that I will consider while, looking at how I would be putting my goods together for my clients? And I think there was a lot of more variables that have now come into the picture. How will I be impacted by shipping disruptions? How will freight costs be an impact as if I manufacture in a particular location? And similarly, on the procurement side as well, if I have dependency on a particular country or a particular supplier, in an event of a disruption, how is my business going to be impacted? While these were all factors that people considered, they were sort of factors that were, oh, one day there could be a black swan event and I need to know about these things. But, that happened. So I think now people are beginning to put a lot of these factors with a far higher weightage while they're considering future trends. And that's leading to a lot of the thought process and the activity we are seeing on supply chain shifts and resilience with our clients today. Of course, the fact that the commodity super cycle has come at the same time, and the shipping considerations around freight pricing and availability of ships and availability of the ability to ship in a timely fashion is a challenge that's coming up. So I think the 2 or 3 things that we're seeing that are coming up as repeated views and dialogues from clients is, one, inventory has moved from just in time to a more sort of let's have a buffer kind of situation, or let's have inventory for a rainy day sort of situation. And that's an increasing trend, one, driven by COVID, two, driven by availability of particular commodities and the price factors. If there is a view that price will go up in the future, then there's a desire to hedge that price increase risk and try to get some cover around that. And lastly, I think the other point on inventory we're seeing is that the chip shortage that's there is also, for chips no longer are tools limited to particular industries, but from auto to semicon to hardware, you see them everywhere. So you're seeing clients very actively trying to solve for chip shortages as well. That's one set of impact we're seeing. The other thing that we're seeing is, as you've also pointed out, resilience. I think corporates, and I'm sure Maisie and Sophia will agree, that the corporates, there's a strong focus on supply chain resilience and making sure their ecosystems are as well geared for the future as the clients concern themselves. And as a result, banks are playing a larger and larger role in getting involved in ensuring sustainability and resilience of these particular supply chains. And for markets like China, we're seeing a China +1 strategy. Make for China in China, but look at having alternate locations for global sales and for global procurements. We're looking at beneficiaries within Asian markets and beyond. So, obviously, classically, Vietnam, we've seen India, we've seen some of the other markets in ASEAN that have become alternates, or at least second options in many cases to the traditional first manufacturing option. And on the converse side, we've seen a diversification of the supply chains in terms of procurement. If you were procuring traditionally from one geography or a concentrated set of suppliers, there is a sense of diversification, coming from there. Just taking an example, when Wuhan was first hit, it is the auto hub, right, of the world. And at that point, certain auto manufacturing clients in other North Asian markets that we have actually had manufacturing disruptions because they were unable to get wiring and similar materials that were meant to come into them from Wuhan. And auto industry, amongst others, is one of the most just-in-time type of industries. So those sort of impacts were also faced. A lot of planning and dialogue ongoing with clients on how to deal with all of this. I think that the impact, if I were to just look at it from a banking perspective for a minute, and as a trade practitioner, is larger usage of supply chain programs. And we've seen record supplier onboarding numbers in the first half of 2021. Over double of what we did at similar times last year. The other impact is clients having much more active dialogues with their finance teams and auditors in terms of sale of receivables. One is to mitigate risk, And the second is to be able to sell to a far wider net and to be able to provide more attractive terms to their clients or to their chain that sells their products within the market. And lastly, we're seeing, of course, because of the commodities super cycle, transaction value sizes have gone up quite considerably. So, clients are, from a risk mitigation perspective, looking at a wider net of solutions, looking at syndicated solutions to put together and get their commodity transactions through the pipes. So a lot of diverse things, and sorry, it's a long answer to your short question, but a lot of diverse things going on around the space. But the net outcome or the net summary of, in my view, the way corporates are looking at this is, how do we make sure we're ready for the shocks that come through the future? How do we make sure our manufacturing, sales, and procurement is sustainable and resilient? And how do we make sure that we are not dependent or driven by geopolitical vagaries?
Thank you for that, Kanika. I think that was super useful to set the context and more the broader picture. I'm going to pick up on one of the points which obviously I know that has been beaten to death, but Sophia, Kanika pointed to the supply chain shifts, and I know that this topic gets talked about a lot, especially with the China-US tensions. Since Southeast Asia and ASEAN is obviously a key remit area for you, Sophia, just wanted to understand, how do you see that supply chain shift happening? Has that really shifted from 2020 to 21? Has that accelerated? And whether Southeast Asia has really benefited from that shift?
Yes, sure. Hi, good afternoon, everyone. Yeah, definitely this is a key topic that we've been looking at for a long time. But what I want to say is that it has started a long time ago. And we've seen a structural change in supply chain, and notably, as you were saying, in Southeast Asia, driven by an actual real growth in population, middle class, new requirements, and also a shift from China to countries like Vietnam, Thailand, or Indonesia that have built hubs of excellence, be the automotive, the electronic, or else. So yes, there is a shift in supply chain, but it's not triggered by COVID, definitely accelerated by COVID, like many other topics that we will be touching on after this. And obviously as well impacted by China-US tension and other, not only this one, but other geopolitical tension, but also we talk about China-US tension, but it's also China-US competition around really the acceleration of infrastructure development with the new plan in the US, but also in China. So it is a structural change, but that has started some time ago. Now, been accelerated because of COVID, continue to be relevant because of the geopolitical tension and all the ESG-driven as well infrastructure and new strategies, and tomorrow with new topics that will come. It just says that this shift is now here to stay, and then the resilience of the supply chain becomes core in all the strategies and the conversation advisory we have with corporates. And mainly, as Kanika was saying, and I will just summarize maybe for me in two core topics. The first one is really the inventory management, the procurement and the inventory management. So indeed, everybody's building up buffer, and that's what is driven what so-called commodity super cycle. Even if it's compared to previous super cycles, this one is very much focused on specific commodities, all the metal family and some agri. And the second core topics of the supply chain new strategies is really the concept of multi-sourcing and more independence and BCPs in the sourcing process, and really a strategy around multi-sourcing and localization as much as possible of the sourcing, avoiding increase of cost, but also independence and availability. So yes, definitely a shift, but let's not focus on one specific event. Is really a chain of events that started, accelerated the shift that existed, and what we see is that it is here to stay and will be driven by even more other things that will come in the near future.
Thanks for that, Sophia. I do want to touch a little bit more on the topic of resilience, since Kanika and Joseph mentioned on this. Let me go to Macy. Macy, is if we focus of, obviously this resilience topic is a very critically important topic in supply chains. I wanted to get your views on how well are the corporates in Asia positioned, whether it's in Southeast Asia or more broadly Asia. How do you see that resilience kind of playing out for corporates in Asia?
Sure. Thanks, Gaurav, for having me here. Before I start on how well the corporates are actually positioned in Asia, maybe I'll just give a little context to what our definition of resilience is, right? I mean, at Standard Chartered, we did a little bit of a survey with clients and we came up with 4 elements. I think Kanika and Sophia mentioned some of the elements, but in actuality, I'll just go through them really quickly. The first one is having an environmentally sound and transparent supply chain. A lot of our clients are now thinking about their direct and indirect suppliers, looking at how they can maintain standards across all these suppliers. The second element that we're looking at for resilience of a supply chain is really how financially robust we can in supporting our suppliers, right, from the smallest to even the large corporate hubs. The third point is having a really flexible and adaptable supply chain, because as Kanika mentioned as well, corporates need to be able to now start reacting very quickly with key events, be it the pandemic or even natural disasters, or things that they can't even really predict for. And lastly, it's about having a really collaborated and interconnected communications with the suppliers and all the participants in the supply chain. So when we talk to the ASEAN corporates, right, we ask them how well positioned they are. These are some of the feedback they've given us. I mean, the first thing is they're still placing greater importance on monitoring the direct suppliers versus the indirect suppliers. So they recognize that there is still a lot of room for improvement in reaching out to their suppliers, right? The second thing they've also mentioned is that they do recognize the need for supplier diversification. However, it's still a little challenging when it comes to locating for new suppliers, onboarding them, and even making payments in some of the jurisdictions. And lastly, definitely, there's also a need to have more transparency. So Asian corporates are actually asking about what their competitors or their peers are doing in a similar industry and how they're operating and their roles of the supply chain. So all in all, I think we see that there is a shift. They are trying to work towards building a more resilient supply chain, but definitely lots of room for improvement.
Thanks for that, Macy. I think that's and kind of tease up our next topic around, you mentioned around obviously resilience, but it's kind of goes hand in hand if we think about the transparency, and then that comes along with the whole underpinning of digital. So I want to spend a little bit more time on the impact or acceleration of digitization, and maybe I can start again with Kanika, maybe yourself, just keeping the same order. But when we think about, obviously we've seen as impact of COVID, as I think Sophia also mentioned, some of these things got accelerated. So digital adoption itself has kind of accelerated by quite a while, big margin now. But I wanted to understand in terms of the trade finance value chain, are we seeing the entire value chain kind of getting digitized, or is it really only parts of those which are really getting digitized? Because this has traditionally been the most manual and paper heavy business for decades and decades. And while we are seeing some shifts, not sure whether those shifts mean the entire value chain is getting digitized. So I wanted to kind of start with a broader view, and then we'll kind of go peel the layers in terms of what are the impediments leading up to that.
Absolutely rightly said, Gaurav. It is a process. Trade by definition is multi-party and has multiple steps along the way. And digitization, the way we're looking at it, is in three broad categories. One is, how as a bank do I process trade? Second is, how do I connect with my clients for their trade needs? And thirdly, how does the trade ecosystem function in collectivity to deliver this for the client. So if I were to go with the easiest option, which is how do I process my transaction, we're leveraging a lot of technologies like OCR, artificial intelligence, etc., to be able to provide our clients with better, faster service, and as a bank to have more robust operational controls, less risks of fraud and other events of that type, as well as have a much more regulatorily compliant and easy to manage shop. Now, as you would appreciate, connecting with clients and delivering to clients digitally needs for our own shop to be digital first. And as a bank, Citi was fortunate enough to have invested a lot of time and focus and economics into getting the foundation strong. And now we're building upon that in terms of the connectivity. And that brings me to the second point, which is how do we connect with our clients? One, of course, which most banks and non-bank trade providers do is through their proprietary platforms, where clients earlier traditionally still wanted to use paper or email or fax, but COVID has sort of accelerated the need to be on digital platforms and the ease to be on digital platforms. So there's two things we've done in that space. One, of course, we have, obviously invested on very strong proprietary platforms like Citi Direct and Citi Finance that we have within our portfolio. But more importantly, we've sort of streamlined the underlying documentation and process requirements, because it's not enough to say, hey, please send me everything via my platform. But unless I can simplify that for you further, that's the real value. So that's one step in the business. And then moving forward, what is important now is that a bank and a corporate are not the only two players in this trade flow, right? You have governments, you have shipping agents, you have the bank on the other side of the transaction for the buyer or the seller, based on if you're doing an LC transaction or an open account transaction, etc. The getting all of these people into various levels of digitization, and that journey, I think, has been accelerated by COVID, if at all there were a silver lining. So you're seeing, in Singapore, for example, the whole efforts around the e-bills of lading. In China, the e-draft infrastructure. In India, the regulatory work that the RBI is doing around export and import streamlining and how import payments and export receipts are processed. So there's a lot of work being done there. And then you have third parties. You've got, as your slide also showed, blockchain providers. You've got fintechs who are looking at simplifying part of these processes. Now, if I were to look at a nirvana state or an end state, you'd want one interoperable system where a client can log in and all of these parties can log in and all the banks can be providers. And, whoosh, everything goes through digitally. We're not near that end state, but everybody is doing bits and pieces of getting to that end state and simplifying processes. Commonality of digital code. SWIFT is taking sort of a leading stand there. BAFT is working on setting digital standards for banks, regionally to be and globally to be able to operate on. And all of these clients are also simplifying their own processes to be able to work with banks, third-party providers, as well as the other players in this chain to be able to get more digital. So it's a journey. I think we've come a long way from where we were, but it is nowhere near the state of nirvana that I just alluded to.
Yeah, no, so very nicely put. But I want to pick up on one of the points which you mentioned. Obviously, regulatory challenge is a structural challenge to this business, and I want to dig a little bit deeper into that one. Maybe Sophia, in your views, obviously, as Kanika mentioned, there are bits and pieces happening in different markets, right? The e-bill of lading got a lot of press, which is great, but the interoperability, especially if we think about bilateral trade across the region, even if we don't think about intercontinental trade, wanted to get your views on the regulatory challenges around digitization, and how do we move kind of in leap forward rather than do these incremental aspects. And I know this is a golden question and you might not be able to answer this directly, but I just wanted to get your views on how do we actually see these challenges, and what do you think are the ways to go forward?
Yeah, thank you. I think let's take a step back to understand why trade is so paper heavy and why is it actually very challenging to digitalize the whole ecosystem front to end? Is because at its inception, at its definition, is around trust and is around ownership of underlying goods. And it's all about legal aspects and legal documentation. So that's what makes it very difficult to digitalize as compared to normal open account payments and what we see in cash management or even in capital market situations, because you are actually changing ownership hand to hand, and on top of it, on a cross-border perspective between different jurisdictions. So the actual real leap and change that will drive the digitalization of trade is actually regulation and legal reforms. The technology remains the catalyst and the facilitator, but it's definitely not the ultimate solution. It's necessary as a catalyst, but will not solve the overall issue. So here comes the regulation and the actual legal reforms. Obviously, trade is a big part of it is cross-border, but not only. We also have domestic, and the easy way to start is on your own perimeter and the country, which many countries are starting to do, and notably Singapore and Hong Kong being at the forefront of all that in Asia Pacific and even worldwide. To be honest, we've been talking about the electronic bill of lading in Singapore. It's one of the first. Obviously, we will have to go cross-border, but we will have to start domestic, get the adoption and the actual jurisdiction and testing from a legal perspective in order to get this legal acceptance. So I think it's nascent, but we've seen actual reforms happening in many countries and a real interest across the board and understanding that the digitalization will have to go through the legal and the regulation aspects themselves. ICC being the overall ruler for a cross-border trade is definitely working on it, and with the electronic ICC or digital ICC rules and books that are being discussed and issued. But the government-to-government conversation and regulator-to-regulator conversation and adoption will be necessary. Obviously, it will take time, but starting to do it already at the domestic level or bilateral level in Asia Pacific is already starting to see some results. As we were saying, Singapore, Hong Kong, Singapore, China, and many other countries in Southeast Asia within ASEAN building those agreements.
So that makes a lot of sense. I know it was a very tough question, Sophia. It's like looking into a crystal ball. But I want to also pivot to one of the other elements. We talked about governments, we talked about the bank's own technology, but let's talk about the overall ecosystem. And let me go to you, Macy. If we think about all the different potential players within this ecosystem, so with banks, with fintechs or tech fins or third-party liquidity providers, I wanted to kind of get your views into how do you see the evolving role of that? How do they actually kind of come together? How do you see that being a level playing field to eventually get the best solution for the buy side?
Sure. So Gaurav, I think in your earlier survey, you showed that there was a slight increase in your corporates actually using a third-party solutions provider, right? But yet that's still a pretty small number at 15%, I'll say. I think the reason being is that trade solutions, the digital problem statements that we have are so varied, as Sophia mentioned. There's some to do with AI, data, documentation, KYC, or even e-signatures or duplicate financing, right? It just really runs the gamut. But I think ultimately, the key thing to having a seamless digital trade offering is really collaboration between all these third-party providers. So what we have to do is come together to give the users better user experience and client service versus the actual product itself, right? So how can we work together? First thing, the fintechs, they have this proprietary technology, and they do have a wide array of solutions that they're trying to cater to based on different clients' needs. What the banks can do is actually work with the fintechs to make their product and services more scalable. right? And for the technology companies where they are actually providing valuable platforms, like some of them that are already partnering with banks, what they can do is provide the banks end-to-end services and even help them with white labeling some of the bank's products. I think ultimately banks are definitely taking an interest in all of these third-party players. I mean, we've seen some different financial institutions out there taking minority stakes in fintechs, working with them on proof of concepts with the intention to scale. I mean, even at Standard Chartered, we have SC Ventures where we're working with different players in the ecosystem. But tying it all together is, as Sophia mentioned, right, regulatory. So, I mean, even in ASEAN, we see Singapore taking one of the forefronts in building more tech solutions. We see Hong Kong too, but I think ASEAN, at least in the market where I'm covering, we see that there is also an initiative to work across the various regulators. So these regulators, if they come together and help to implement friendly trade digital policies, it could serve as a framework for all of us to work together.
If I may just add one point here, and I totally agree with what Maisie was saying, is that there are fantastic technology solution by those fintechs and proprietary solution, but let's not forget that trade is an ecosystem, as we said, and it cannot. And today, what we are saying is really the way we say it, maybe in the banking jargon, but it's digital islands, and they are not connected. So for the clients, when we talk to our clients around the blockchain technology or others, it's interesting, but they will always focus on a specific topic, either on the finance front, for example, or the procurement or the logistics. But it doesn't solve the overall equation. And I think corporates are looking for one solution that includes all this. And banks have a really a big role to play here, as to be fronting and ensuring that interoperability, as we say, and connecting those fantastic solutions by the fintechs, notably, and other parties, but building an ecosystem. Otherwise, there is no trade if there is no ecosystem. So I think that's very important topic in this digitalization conversation.
Yeah, and let me add on that one, Sophia. I think that's a very important point you made, because as you said, a large part of that onus or responsibility still lies with the bank themselves. I think there is still that level of trust and comfort of working with a bank coming from, especially with large corporates. Doesn't mean that there isn't a role for the fintechs or tech fins to kind of provide those last mile solutions or those bridges, which can be quite tough, to say the least, in a traditional bank construct. So we do believe that there is that level playing field where it becomes a complementary ecosystem and makes life a lot more easier for the buy side. With that, I want to pivot and focus now on one of the hottest topics across the world. And this gets mentioned everywhere and anywhere these days. And while I want to get more macro views, I do want to, with the help of all three of you, want to go a little bit deeper into the role of ESG in trade specifically. Sophia, let me start with you first. Obviously, when people think about ESG, and the first thing which people talk about is around green loans and capital markets like green bonds and green financing. But we've not really seen that proliferation coming through in terms of the working capital financing aspects of it. So that, like, the day-to-day aspects of it, it's not really yet proliferated there. So just wanted to get your views in terms of how do you see what are the key challenges or roadblocks do you see in that adoption, and what do you think could be the benefit of going down that route for some of the largest corporates in Asia?
Yes, thank you for this question. I think it's really a key question for the future and the success of ESG KPIs for all of us, and notably on our day-to-day. We've been digging a little bit deep this year, notably into why is the ESG and notably in Asia not picking up so much into the working capital procurement, working capital cycle, and specifically trade in Asia in terms of demand, while there is a lot of offer and notably a lot of push by the regulators in Asia in order to incentivize and encourage the different corporates into embedding this into there's even subsidies being given. The latest one, we've worked in collaboration with the MIS in Singapore to develop a specific supply chain, sustainable supplier financing framework for the corporates in Singapore. And the take-up, I mean, there is a lot of education that still needs to happen, and a lot of conversation with the corporates that are interested but not yet signing on the actual commitment. So we've talked to many clients in order to try to understand that, but not only, we've spoken also to institutions, notably the IFC and others that work a lot in the region in order to develop these kind of KPIs. And if I would summarize, I think there are two key challenges that have been highlighted. The first one is the fact that the ESG KPIs and strategy at the corporate level remains really too high compared to the treasurer's own KPI and the finance department own KPI. So it still kind of stays at the board level, the corporate finance kind of conversation, and the project and the infrastructure investments that are happening. It doesn't go down into the treasury management of a corporate. They are well aware of the KPIs of their own corporates and board members for their specific company, but they haven't yet translated that KPI into the different component of the company up into the treasury, which manages the day-to-day business of the bank. So it's still looked at the board level as a way to help the transition and the investments, the large investments for the companies, and it hasn't go down yet in terms of translation for the day-to-day. The second thing is that even when we go and look at doing it at the working capital level and trade, the homework is still very heavy. There is a lot of and that's why it works for project finance. You have this long leeway and timeline to actually execute a project financing with many stakeholders and advisors, and it takes many months. So in parallel, you can work on the assessment of your sustainability goals and how you're going to actually follow them. There is a lot of pre-work that is necessary. When we're working on working capital and trade, it's very short-term, be it in terms of financing, but also execution and implementation. And it's still driven, obviously, by cost and by availability of line. So all that effort in order to translate it, put in place the KPI, decide how we are going to monitor that at the company level, it's still not accepted, and it's still too heavy for the treasurers that are managing the trade facilities, to be honest. Here comes, I think, one of the key value add that banks can bring in, because we have experts, all of us internally, who are doing it for the project financing, for the bond issuance. We should facilitate it for the working capital, work on the technology component of it, because going back into digitalization, technology will play a big role, notably in the assessment and the follow-up, and facilitate, make it more accessible to the treasurers in order to be able to execute it. So these are the big challenges. How it's not going down from the board to the treasury in terms of practical implementation and KPIs, and two, the homework that is still quite heavy in terms of assessment and follow-up, and it's our responsibility, obviously, to simplify that and, as I say, make it more accessible to them.
Yeah, it's very interesting you mentioned the homework part, because as part of the whole trade study, when we were speaking to a large part of corporates, a large part of the corporates, also treasurer, said, well, you know, is it really worth it to do all that paperwork for a few basis points of my interest rate? Why doesn't the bank just reduce the interest rate right there and then? So I fully agree with you on that paperwork, because as this is going through an evolution, obviously it will take some time for these processes, this paperwork also to get a lot more standardized.
Yeah, and I think we have to say, and this is part of the communication that probably we're not doing that much, or we have to improve, is to explain that it is worth it, because without an ESG component into the trade and the working capital, we will not move the needle globally on it. Trade, that's at the core of everything. It has a huge impact on what the ESG KPIs will succeed or not globally, be it from a societal perspective, environmental, and many other aspects. I think, yes, it's definitely worth it, and we need to insist on that.
Oh, makes sense. I think, Kanika, obviously, ESG is obviously a very topic for Citi, especially in Asia. We saw the ESG report which Citi has released there as well. When we think about the unique opportunities and challenges for ESG in trade, I think it'll be great to get your views in terms of, as Sophia said, that whole transition from the board or at a corporate finance level to the treasury level. Do you see any differences when you deal with, let's say, multinational subsidiaries operating in Asia versus Asian corporates, as well as it'll be good to get your views in terms of whether you see any differences across the different markets in Asia?
Sure, thanks for that. And, Sophia made a very good point around the effort involved around getting the ESG credentials for corporates and getting their strategy in place versus the benefit given the short tenor nature of our trade. And that's sort of always a question that comes up in dialogues. But from what I've seen, and I think what personally the focus will largely be on the supply chain side of the business. So today, if you have a set of suppliers who have particular KPIs and you want them to improve it by particular notches, the best way to do this is to incentivize via price. Saying, if you're on a supply chain program and you improve from position A to position B, your rate improves by a further 5 basis points or deteriorates by that number. And then there is a measurable cadence around it and an end state goal. And as most corporates partner with firms that are specialists in terms of supplier appraisal and KPI monitoring, and banks also sort of leverage these partners to be able to work around those ratings and provide a third-party validation to the whole supplier rating process. So I think on the supply chain side, we're increasingly seeing as we have dialogues with our clients, a greater share of mind on bringing this down to reality and implementing it. And we're also seeing a greater cadence around it that the clients are already building. And to your question on are we seeing this slightly differently with global corporates and Asian offices? I think, yes, I think they're a little further ahead in the curve many a times. I mean, not to generalize, but they seem to be having global corporate governance laid out, tie-ups with these firms that are doing supplier ratings, KPIs set out, etc. And in many cases, we work with their offices in Asia to help them to localize these as necessary, or work together on an advisory capacity in that space. So we've actually done our pilot ESG supplier finance program with a company in the fast-moving consumer goods space last week, and it was very well received, and we do think that there will be a strong replicability around that space. So that is, I think, going to be the bedrock of ESG agenda in trade. And I think the two other peripheral areas that will continue to be critical trade ESG solutions will be one on the agency-backed solutions, which are slightly more medium-term and longer tenor. So, if you're doing a green plant, a green power, solar power plant financing via an ESG an EF cover, could those sort of transactions be ESG compliant, both from a client's perspective, an agency perspective, as well as from a bank perspective? And again, we've had some successes there in Indonesia, where we've had agency-backed loans of $500 million ticket sizes that have met the ESG agenda for all parties involved. And then lastly, if we look at working capital loans for corporates, in that space, I think the complexity is the highest there, because a client may take a 30-day or a 60 or a 90-day loan and may not need to take it again. How do you measure improvement in KPIs? if it is episodic or if it is so short tenor. I think there we are focusing more on end use proceed and use of proceeds sort of scenario. So we've done a transaction with a client where the use of proceeds were first for a rice farmers on a rice exchange led by one of the multilaterals, and there was a clear demonstration of the ESG benefit of use of proceeds. So it'll have to be different strategies along the way, Gaurav, across all of these, but a lot of clients on different levels of the chain here in terms of readiness and in terms of bringing it down to granularity that Sophia was alluding to earlier.
Yeah, absolutely. We definitely see this as something which is, nobody denies the importance of it, but the clarity and the I would say the frameworks which we are going to be using, I think that's definitely an evolving story at this point of time. So let's kind of look forward from here. And Macy, I think if I can go to you to kind of get your thoughts on how do you see the role of ESG especially in the trade finance, more broader trade finance and supply chain aspects? How do you see the role of ESG for, let's say, for the next 5 years or for the next decade? How do you see that playing out?
Sure, Gaurav. I think the role of ESG in the near term would be around 3 C's, right? Carbon, collaboration, and compromise. I mean, I see actually MNCs leading ESG because a lot of them, they are making the commitment. The challenge would be their suppliers, because many of these suppliers critical to delivering the corporate commitments are still in emerging markets, right? Out here in ASEAN or even some parts of Africa. So we definitely see a lot of collaboration between the MNCs and their suppliers working together to have shared goals to bring their ESG agenda forward. I just want to spend a little bit of time on carbon because we just released a carbon data report from Standard Chartered. And basically, we've seen that a lot of these MNCs, actually 78% of them, are planning to remove suppliers that endanger their carbon transition plan by 2025, right? That's really, really close. And closer to home, 91% of MNCs with a supply chain in Singapore, they have also set emission targets for the suppliers based out here. They asked to reduce that by at least 30% by 2025. So for these suppliers who fail to transition along their MNC partners, I mean, this could actually translate into a potential loss of export revenue, right? It is something that I would urge corporates to think about and work closely, collaborate with their MNC buyers to see how they can have shared goals and transitions towards this.
If I can just at one point, I think that I hear it as well a lot in our internal conversation, and we tend to not highlight it, is we talk a lot when we see ESG around carbon, water, new mobility, environment in general. But the societal aspect is becoming more and more core to this conversation. And I think that COVID has definitely accelerated that as well, with all the impacts that we've seen across sectors and in different countries, with the loss of income and issues around that. The societal impact and what we can help us and the large corporates into moving the needle there as well through our financing of structures will be more and more central to the conversation. Kanika was mentioning definitely the bigger adoption into the supply chain structures around that. It started actually with the societal impact, with the textile companies and all that, notably in Asia and in Hong Kong, to drive the agenda. And I see it coming back. I think we need to put a little bit more emphasis and conversation around the S part as well into the ESG more and more. And that's definitely something that COVID has also accelerated. And as Maisie was mentioning, the potential lack of export proceeds and revenues for corporate if they don't adhere to certain requirements with the suppliers, definitely an impact on brands and revenues for a large of corporates if the societal part is not also tackled So really encouraging that message as well.
Yeah, I think that was very well put, Sophia. So you're absolutely right. So even while talking to a large part of roughly about 650, 700 large corporates, I think the first thing which comes to everyone's mind when you talk about ESG is the E part. And while, and I think the S, the societal part has taken backseat, but as you rightly put, what we have gone through over the last year and a half or 2 years, and I don't know how long will this last, but it really brings out the importance of the S part to be at least on the same level playing field as E and G part as well. Okay, so I think, thank you for those comments. I think this has been very helpful. We have about 3 to 4 minutes left, and we do have some questions from the audience. So, so I'm going to cover 2 questions from the audience, starting with first question, and I'll leave this to any of you to take this question. The first question is around technology, more specifically blockchain. And 2 to 3 years back, blockchain was the buzzword in trade. I mean, it continues to be on the sidelines, but still a buzzword. We've not really seen that proliferation kind of coming through. We've obviously seen more and more episodic transactions happening, and nobody denies the benefits of the blockchain, but that proliferation has not really come through. So I wanted to get any of your views on how do you see this playing out? Do you see blockchain kind of keep getting to that stage where it is used universally and used in more cadence than what it is right now? And how do you see that timeline happening?
Maybe I will start quickly, and I will definitely leave it to my colleagues just to say, again, technology is just a catalyst of digitalization. So yes, blockchain is one of the key technologies, but the issue with blockchain, I suppose, with many corporates is their own readiness with their system to accept that, forefront technology. There are other solutions today that are less complex, that fits better with the company's systems readiness and ERPs and internal system readiness, and we see them taking up much faster, and that's the simple APIs. So that and I think they solve a large part of what blockchain solves, and they are easier to implement and accept by the ecosystem. Blockchain definitely still is and will be a solution. It needs some time to be able to get accepted and embedded in the ecosystem, existing legacy system, while APIs solves 80% of it and it works. But it's just the beginning, I think, of the blockchain story.
Yes, and I think just to add quickly to what Sophia said, right, blockchain is also provided by many different third-party providers as well. So again, it's us deciding, and corporates as well, who they want to work with and how this adoption is going to go. I think for different technologies to take off, it's definitely important for local regulators to also give certain guidelines. And sometimes it means making it mandatory, right? That's when people start to have to go, okay, I need to change.
Yeah. That makes sense. We have a very interesting question from the audience, and let me read it out. The question goes around, what is the trend in selecting the right partner for supply chain finance? A global bank or fintech, or more at a regional level and potentially local level, depending on how the purchasing department is organized? What is the best way to look at it in any of your opinion? I think this is a very interesting question, as especially within Asia being so heterogeneous. I think it'll be good to kind of get your views on how do you tackle with the complexities at a regional or local level.
Maybe if I can take the first stab at that one, Gaurav. I think the first, if I were in the shoes of the lady or gentleman who's asked this question, the first thing would be, what is my particular business model? So if my business model is limited to one country or a set of countries, or if it's a global business model, my choice of bank could vary significantly based on how many markets I want to cover and what sort of a homogeneous solution I require for my suppliers across the market. I think the other consideration factor would be how many of my suppliers are domestic, how many of my suppliers are cross-border. Do I have large ticket size, what we call alpha suppliers, or do I have a long tail of very tiny suppliers? And the onboarding requirement would vary across both kinds of suppliers. So those are the considerations I would map out as a client first in terms of my determinant factors. Thereafter, then with the choice of the bank or fintech, I think in a supply chain solution, it is not ideal to have too many multiple banks or fintech providers, because ultimately you're trying to connect and maximize the benefit that is going out to this particular ecosystem in a consistent and sustainable fashion. So, if you want to get to scale, or you have a scale that's larger than what one particular fintech or bank can handle, there is always the ability to put a club structure together to get other participants to come in behind your core anchor bank or fintech, as the case may be. And that is the party you interlink with, you do your technology integration with, and you sort of interface with in entirety. That's the model I would go with, and which is why the choice of the partner you choose, you would sort of have a few factors. One is the ability for them to take the size of asset and balance sheet that you need them to. Secondly, obviously their track record and how long they've been in the business, and what is the technology that is offered by them. And lastly, we've had events in this particular industry where we've seen particular players vanish overnight. So you need to have a partner who will be there and who will be able to, you don't want to wake up the next morning and not have a supply chain bank or fintech provider present. So I would say, keeping all of these factors in mind, I would not go with a very widespread approach, but my choice could be local or a regional or a global bank based on my own business model, as well as some of these factors.
No, I totally agree with Kanika. I think specifically the last point around the independent players and the different news that so we have to be careful. I will just add one thing, is that for supply chain solutions, be it payables or receivables, I will advise the corporates to be very thorough in the way they choose, because the solution you take, or even the 2-3 banks that you will choose, drives a little bit your commercial strategy after that, because this is a product that actually drives your commercial considerations and your contract negotiations. So it's not only financing, it actually is embedded in your procurement and commercial strategy and perspectives. So when you choose a provider, is definitely keep that in mind, because that's the value add of the product compared to a simple financing. And 2, you need a provider that will help you continue to scale up, because obviously that's the goal of everyone, to grow and scale up, and that will support you in scaling up. Now, technology-wise, definitely there is a lot of choices, be it third-party provider or proprietary platforms. I will not say this one or the other, but let's keep in mind that you have a connectivity angles today that helps you connect to multi-platforms. You don't need to go through a third-party platform that connects you to financing banks. You can still, either through your SWIFT network or through APIs host to host, simplify your connectivity to the bank's platforms or other platforms. This is today more and more implemented. Keep that in mind, and obviously this is something that all your bankers are happy, and we're happy to support you in that execution. Keep that in mind. The connectivity is getting much simpler now, so you are not driven in one way or the other, or driven to one single platform that give you access and could be an issue in terms of investment.
Makes sense. Thanks for that. So I think we thank you for those comments. I think we are on the hour now. So let me just close this off with some thoughts. But first of all, I want to thank everyone for attending this session, especially my esteemed panelists for the great discussion. We will be sharing the slide deck and a link to the recording for reference in the next 24 hours. But again, thank you so much for spending the spending your time with us today, and hope you have a good day.
Thank you, everyone. Have a great day ahead.
Thank you.